A winning strategy for the beginner trader. In this lesson, we'll learn how do statistics affect the Forex market, what is the discipline of trading, and why is it difficult to abide by? How can you attain returns without risk? A winning strategy. What is our goal in trading? Our goal, ultimately, is to invest a certain amount of money and profit as much as possible. Let's say 20% return in 1 year. If you invested $100,000, the return would be 20,000 USD a year, the dream of every investor. Let's do some calculating and examine how much one would have to profit a day. Not considering weekends and holidays, we arrive at 200 active and full trading days. In other words, we have to make $100 a day. If you invested $100,000 in stocks, and theoretically stocks can fall 10 to 15% in a day, we've seen it happen lately, it would mean that you're risking $10,000 to $15,000 a day in the stock market in order to profit $100 a day. Why risk so much if you can perform a transaction of $10,000 in the Forex market, risk less, and gain more? In this lesson, I'll teach you a winning strategy. It all depends on you and how much motivation, will, and patience you have to execute it. Market analysis. In the money market, there are analysts, economists, and forecasters. Everyone's trying to forecast which way the market will go and whether or not it will rise or fall. If they can do it, I can forecast as well. If the euro will rise or fall, and we've already mentioned that it's much easier to forecast the Forex market, you too can learn how to do it, and you can always seek their help. Remember, in this market, nobody has an advantage over you. Let's go back to the transaction we were discussing, the 10,000 euro transaction. The value of each pip is $1. Assuming that I was right and the euro rose by 100 pips in a day, I profited $100 in 1 day. I could place a stop-loss order at 50 pips and risk $50, or I could place a stop-loss order at 100 pips and risk a maximum of $100. Why do I have to risk 10,000 to 15,000 US dollars in the money market in order to make $100, when in the Forex market I can risk a maximum of $100? So now we arrive at the interesting part of this lesson. We'll see how we set the level of risk in the Forex market to commission payments alone, meaning 3 pips a transaction, and how we'll be able to have a 50% annual return. I have a young child, 5 years old, Jonathan, and I'll make him a Forex investment manager. I have a portfolio with $10,000 in it, and every morning on the way to school I ask him, "Jonathan, my dear, what is Mummy going to do today? Will she buy euros or sell dollars?" Whatever the child says, that's what I do. If he says buy, I buy 10,000 euros. If he says sell, I sell $10,000, and so forth for 100 days. For every transaction, I set a stop-loss order of 100 pips and a take-profit order of 100 pips. That means if the child is right, I'll make $100, and if he's wrong, I'll lose $100. How many times do you think out of 100 transactions did my son make $100, and how many times did he lose $100? The answer is 50-50. It's statistics. Ultimately, it comes out to 50-50. My son guesses, and the euro can rise or fall. There's no other possibility. It's like flipping a coin. What will my son's account balance be after 100 transactions? 50 profitable transactions and 50 non-profitable transactions. $10,000 is the original amount, minus the commissions that will be paid. Assuming that commission is 3 pips, and every pip is $1, then 3 times 100, or rather $300, meaning my account will come to $9,700. Note, a 5-year-old child trades without any knowledge in the field and only loses commission. How do you explain it? A 5-year-old child is better than an experienced Forex trader. How does he only risk commission? I'll teach you now. Guaranteed victory. To arrive at a situation in which the maximum risk is the commission alone, one must abide by 2 rules. The integrating rule: proper leverage plus statistical information equals guaranteed victory. In order to achieve minimal risk, you need to divide your portfolio into many smaller portions. It can also be said in another way. It's forbidden to risk more than 2 to 3% of the portfolio in one transaction. What does that mean? If I open a minimal portfolio of $10,000, I don't risk more than $200 to $300 in one transaction. How do I do this? I set a stop-loss order at a distance of 200 to 300 pips. And why? When you flip a coin, you can get sequences of heads or tails. It's not 1 time heads, 1 time tails. It can be 5 times tails and 3 times heads. When we add up the result, it comes out to 50-50. Statistics is on your side when there are many transactions. And as we've said, out of 20 flips, the coin can land 13 times on heads and 7 times on tails. But there is no need to worry. It will balance out later. What can we do? Statistics is an exact science. Therefore, it's forbidden to arrive at a situation in which you have no money left for trading, because then the game will end and the whole theory which I'm teaching you is discounted. So what's the chance that my son on the way to school will lose 20 times in a row, or that I'll flip a coin 20 times and it will land on heads? The answer: 1/2 to the 20th power. In other words, 1 in a million. The chance that you'll lose 20 times in a row, even if you're a 5-year-old child, is 1 in a million. And what's the chance that I'll lose 30 times in a row? 1 in a billion. It will never happen. You'll never be able to erase your entire portfolio. Statistics is on your side, so never forget the rule. Don't risk in one deal more than 2 to 3%, so that if you lose in a few transactions in a row, nothing happened. You've enough money to continue trading. And eventually, the account will balance out. As a reminder, the interest of the brokers is that you leverage as much as possible so that they profit more from the higher commission. But you should worry about your interests. Don't leverage more than 2-fold, or at most 3-fold. In special cases, I allow you to leverage once a month by 4-fold, and I'm being generous. So why not leverage 100-fold? Because we'll assume that you've deposited $10,000 and you've performed a transaction of 1 million euros, which is a leverage of about 100-fold. How much is each pip worth? $100. As we mentioned, the euro can shift about 100 pips in a day. So if the market is against you by 100 pips, you'll lose $10,000. In other words, you'll lose all your money in one day. It's true that you can lose all your money from commission payments, but if you don't understand the market, you don't identify trends, and you don't know how to forecast when the euro will rise or fall, please don't trade. It's not for you. Trap 1. Size of leverage. Let's see why everybody falls into the trap. Let's discuss the significance of the size of leverage. You learned a trading strategy and you're starting to gain. The strategy works. The day comes that you've been trading in the market already for a couple of months and you're making very substantial gains. You've become an expert in the euro. Your life is the euro. And then, one day, you're sure that the euro is on a rising streak. You read it in articles. The graph of the technical analysis shows a jumping point, and the G8 is convening, and they say that they have to fight the strengthening of the euro. Everybody already knows the euro is moving upwards, and you're saying, my money's doing nothing. Why don't I make a large transaction of 1 million euros? There's no doubt that the euro is going to rise. And then you think, no, we said it's forbidden to leverage. You hung in there. You didn't let your emotions get to you, and you went by the book. You opened a transaction of 10,000 euros. Well, that was obvious. The euro rose by 100 pips. At the end of the day, you feel like a loser that you made such a small transaction. You gained $100 because if you'd leveraged, you would have gained $10,000. And you say to yourself, my money was doing nothing and we didn't make use of it. No big deal. What's important is that I'm sticking to the rules that I've set for myself. Another day passes and you say, today the euro's definitely correcting itself and it's going down. And you open another small transaction and you were right. And so forth for another 1 or 2 times. Now you begin to break down. And then comes the day when you're sure the euro will rise and you're tempted to open a €100,000 transaction. And then what happens? The market is on your side. You profit. You earned a 10-fold increase, $1,000 in one day. It's fun making $1,000 in a day, right? So now you begin to get carried away. You're able to make $1,000 in a day, $2,000, $3,000, and then you lose $5,000 in one day. Without noticing it, you've ended up in the big shiny casino world. Ultimately, in the casino, everybody loses money. Statistics. Question. Do you think that now you can go back and trade in €10,000 transactions? Not anymore. Trap 2. Improper use of stop loss and take profit. You've placed a stop loss order for 100 pips below the entry price and a take profit order at 100 pips above the entry price. The price drops by 100 pips. It arrives at the exchange rate for which you've set the stop loss order. The stop loss goes into action and the transaction is automatically closed. And as the transaction closes, the exchange rate goes back up by 200 pips. After 2 days, you do a similar transaction. The market falls and the transaction is automatically closed at the stop loss point. It drops another 10 to 15 pips and then it rises again by 250 pips. At this point, you're telling yourself, if only I'd removed the stop loss limit a little lower, I wouldn't have gotten out with a loss of $100. I would have come out with a profit of $100. After a few times of this happening, and believe me, it happens a lot, you break and you say to yourself, for the next transaction, I'm moving the stop loss limit another 20 pips, a total of 120 pips. You start a transaction with a new stop loss limit, the price goes down by 110 pips and then makes a U-turn and rises, and you end the day with a profit of $100 instead of a loss of $100. You were satisfied because you moved the stop loss limit by 20 additional pips and you made money. Great! The next day, the exact same thing happens. And the third day comes, the price drops and you move the stop loss limit back to 150 pips and you make money. The fourth time, it falls more and more, and you move it to 200, 250, 300, 350, even 400 pips. And now, you've lost $4,000. And you know what? There's no chance the exchange rate will go back to where it was previously. You couldn't close the position at $300, so at $4,000 your hands will tremble. In addition, you're certain that there's no chance that the market will continue to move against your position all the time. Trap 3. Deterioration. Okay, you have to arrange more money. You got a loan from some friends. You know that the currency will correct itself, but you don't know when it will come. If you've already been there, you won't be there when it comes. For emotional reasons, you can't close the position and you continue to get more loans and the loss continues to grow. Guys, do you insure your homes? Do you pay a premium on your insurance? Do you have life insurance? Have you got car insurance? The stop loss order is your insurance premium so that you never lose more than you can allow yourself to lose. Do you know what a balance sheet of losing clients in the Forex market looks like? 98% of their transactions are profitable. Most traders gain in small amounts and lose in huge amounts, and that's how most people go down. But whoever knows how not to lose more than 2 to 3% in a transaction, and whoever knows how to leverage, sets the risk in the Forex market to a loss of commissions only. And you know yourself and your character, and you know no one will force you to leverage 100-fold. Whoever knows that his character will mentally force him to leverage and is not able to risk only 2 to 3% of their portfolio in a transaction should not get involved in the Forex market. It's better for him to go gamble in Las Vegas. He'll enjoy it more there anyway. How to profit. Until now, we've discussed how to protect our portfolios and how we only lose commissions. But you don't want to learn how to lose commissions or fund brokers. You want to learn how to make money. So now begins the interesting part of the lesson. Let's see how much money can be earned in the Forex market in 1 year by risking commissions only. Is there an economist in the world who knows how to evaluate with absolute certainty where the euro will go, in what direction gold or the Nasdaq will go? What will the interest rate be? Will there be inflation? What is a bachelor's degree in economics, a master's, a doctorate, a Nobel Prize, an investment firm, a portfolio manager? Why does this whole industry exist anyway? Simply in order to understand that it's possible to evaluate with certainty in order to break the balance. By how much, you'll see in a moment. Proper capital management. In order to set the amount of risk only to the amount of commissions that we'll pay, one needs financial knowledge that will allow him to break the balance and carry out a few more profitable transactions, in contrast to losing transactions. What do you need to learn to know when the euro will rise? Well, the first thing is technical analysis. This is analysis of prices of a certain currency in order to identify trends and so on. And what is the first rule in economics? Go with the trend of the market. It's a science, and that has to be learned. It's not complicated. In our advanced lessons, we'll teach you how to look at the graph and learn how to identify a trend. Is it an exact science? Not always, otherwise everybody would be profiting. But if you conduct all your transactions from today and onwards in unison with the trend and not against it, eventually you'll be able to have a few more profitable transactions than losing ones. That's the whole game. The second thing that needs to be learned is analysis of economic data. One can explain that when the interest rate in a country rises, the value of the local currency rises because the demand for deposits in this currency increase, so people buy it and then it strengthens. Even a parsley merchant in the market after 20 years knows exactly what the quality of the parsley is. He looks at the leaves and immediately knows if it's a good product or not. He has no degree in advanced parsley studies, but he lives and breathes parsley. Experience is worth more than education. Similarly for you, after a few years of trading the euro, you'll come to understand the euro. You will awaken in the middle of the night and be able to say that the exchange rate of the euro is 1.4266, that at 10 in the morning there is light trading and at night it's latent. One must be cautious around Christmas time, and that when the interest rate is lowered, it flies upwards. So you have to go and learn technical analysis, know the economic data, experiment, practice and profit. Now let's see what you can do if you acquire the minimal knowledge and experience when we break the balance. So now I'll show you a simple business template. I open a business. The name of the business is Euro & Sons Limited. I deposit $10,000 and I'm the Euro King of the world. There are those who sell pizzas, those who sell tomatoes, and my business is to buy and sell euros. I work for 10 minutes a day and make one deal on the way to school with my son, Jonathan. Do you remember him from before? Either I earn $100 or I lose $100. In contrast to my son, I don't guess. I read financial newspapers, I read analysts, I do forecasting, put in my experience and make a rational financial decision. My son, out of 22 transactions in a month, loses 11 times and earns 11 times. How many pips does he lose each month on commissions? If we assume that the spread is 3 pips, then 66 pips. He loses 3 times 22 transactions. The goal of the business plan: to be better than my son. Only once a month. Take the information that I have and translate it into victory. Instead of 11-11, I'd be 12-10 in my favour. Is it possible? Guys, if you didn't understand, we started the trading in the Forex market with a 50% chance, so I want to win against the market just once with knowledge. Is it certain that I'll be able to complete one transaction better in my favour out of 22 transactions? Well, no, there's no guarantee in business, but there is no chance without risk. And if I lose, I'd only lose commission. I wouldn't get loans from my friends or from banks, and I'd never get in trouble in this market. Most of the traders in the world know how to identify the trend, but their problem is money management. I personally have been successful for years now, working in this manner. Most of the traders who've learnt this lesson and the coming lessons have succeeded in breaking the balance, but unfortunately haven't been successful in abiding by the instructions and rules which I set before them. Simple mathematics. Let's see what happens if I succeed in one transaction, which is one more success in my favour. Let's do some simple mathematics. We spoke about 12 profitable transactions against 10 losing ones, right? So, 12 profitable transactions multiplied by 100 pips gives 1,200 pips in a month. 10 losing transactions multiplied by 100 pips gives 1,000 pips in a month. How much is 1,200 minus 1,000? 200 pips. We'll subtract the commission, the spread, that I paid to execute the transactions. 3 pips times 22 transactions is equal to 66 pips of commission. The total collective gain is 200 pips minus 66 pips of commission, so we earned 134 pips in a month. I want to claim the following. If you will, if you learn Euro, if you learn technical analysis, understand the important data which affects the Euro, you'll get used to it, and then once a month you'll succeed more than a 5-year-old. If it wasn't possible, we wouldn't have taught it to you. If it doesn't work out for you, stop trading. It appears that you didn't understand that if the graph is rising and you're told to buy, you need to buy. It appears that you didn't understand that if the bank's governor raises the interest rate, the currency will rise. But if you were successful and understood, then you have 134 pips in a month by working 10 minutes a day. That's all. Let's translate it into money. You have $10,000 in your account. Let's assume that you start with a transaction of 30,000 euros. Threefold leverage. For this transaction, each pip is worth $3. $3 times 134 pips is $402. 4.02% return in a year. It comes to 48.24% by risking commission alone. And what if you attain more experience and knowledge and have 13 profitable transactions in contrast to 9 losing transactions and not 12 to 10? It's already a 96.5% return. Do you know of any investment with such a return? Because I really don't. What amount should you invest? Take the minimal amount of money you're willing to earn in a month and multiply it by 20. Why? We spoke of 5% monthly returns. So, if you want to make $500 in a month, put in $10,000 to open an account. But don't lie to yourself. Don't put in $10,000 to earn $5,000 in a month, because you will surely lose. Why? Because whoever tries to have a 50% return in a month leverages himself too much and will never succeed. Tools for success. We'll give you comprehensive online courses. You'll get used to it, you'll learn, and then you'll begin trading. If you see over time that you can earn 134 pips a month, enlarge your portfolio and start larger transactions. You'll enlarge your portfolio and will operate it in a way that each pip will be worth $20. So you've learned here the basic elements of secure Forex trading and the sums you can achieve on your own when you become an experienced trader. Do you know how great it is to earn a weekly salary without being dependent on anyone from anywhere in the world? Maybe you won't become a millionaire by doing this, but if they throw you to any place in the world with a laptop and a little money, you can earn a good living because you'll have the skill and knowledge to evaluate in which direction the euro will go once a month. Now that you've learned and understood the basic functions of the market, we recommend that you continue with our firm's advanced course, a course which teaches technical analysis and a few more trading strategies. Good luck!